Hi, everyone. I'm Katie Card-Niedermeyer with the Card team at American Pacific Mortgage. So I am here to help bring a little bit of information to first-time homebuyers. My goal and my passion is working with first-time homebuyers getting into their first properties. And I found that along the way, there are a lot of questions. And a lot of these are just upfront and they are scared to get into the process because they don't know some of these things. So hopefully this video clears up some questions that you might have if you're someone that is looking into homeownership for the first time. And I will have more videos after this, but this is my initial one that really is focused on what are some of the initial questions that first-time homebuyers have. So I'm going to go through some slides and some numbers so that I can hopefully shed a little bit of light on some of these things. So the first thing that I want to reiterate is it's very normal to have these questions. And so, you know, I'm just really trying to educate on some of these initial questions that are coming up when you're first thinking about home ownership. You know, will I qualify? It's always something that's really scary. You know, I think that a lot of people don't inquire until later because they're so worried, when really we love to work with clients when they're in the planning process of even saving money or just knowing what they will qualify for. So the big three questions I'm going to go over today are, will I qualify? Do I have enough saved? And is my credit good enough? So first off, let's dive into, will I qualify? The two things that we look at are income and your debts. So here's an example of a salaried employee, right? A W-2 employee, someone that is a salary, they have a salary of $75,000 a year. Their gross monthly, right? So even before taxes, anything is taken out, they make $62.50 a month. So that is the income that we can use to qualify them to make a home purchase. Now, when we are looking at someone who is an hourly employee, it's pretty straightforward, kind of like this. Where we do get into gray areas are self-employed people. So people that own their own business, what they show on their tax returns is what we go off of. And oftentimes people write a lot of things off. So that's something that, especially if you're a first-time home buyer and you are self-employed, it's really important to get with a loan officer to figure out what qualifying income is even, your qualifying income even is, because sometimes it's not what is shown on your tax returns. And it's kind of hard to understand that. So working with a professional that knows how to read that is really important. So then when we talk about debts, we talk about anything that's going to show up on your credit report. So for instance, any student loans or personal loans that are going to come up, any car payments, and then any credit card debt. So the examples I used here is one was a student loan of $250 a month, one was a car payment of $377, and then credit card debt of $90. Now, when we look at credit card debt, if you have revolving debt, that is, let's just say you put $2,000 a month on your credit card and you pay it off every month, that's totally fine. But whenever we actually pull your credit, there's probably going to be a balance unless you've just paid it off. And so most likely there will be a balance, and whatever the minimum payment is, that is what comes up. It's very easy to pay it off and then do a rescore to make sure that we don't have that debt if it's close. But these are the things that we look at. We're not looking at that your student loan is $200,000. We're looking at what the monthly payment is. Now, depending on the program, that could change, but the biggest thing is to understand the income that is qualified and then your debts. So when we look to qualify you, we look at the ratio of those two things. So you have your debt and you have your income. In this example, I used a housing expense, right? So a mortgage, taxes and insurance, okay? A monthly payment that's $2,500, plus the debts that I showed in the past slide, which equaled $717. We will divide that by the $6,250, which is the income, to come up with this 41% ratio. We're looking at ratios. So as long as you're under 50%, you're going to be in a really good place. Moving on. Do I have enough saved? This is a really big question. How much money should I have in the bank? Well, here's an example of if you were to buy a home that's worth $500,000, there are ways to get into homes with only 3.5% down. In this case, that would be $17,500. If you wanted a conventional loan, you'd need 5% or $25,000. A lot of people think they have to wait until they have 20% down. There is a cost savings associated with that, but it is not necessary. In this case, that would be $100,000. So the most important thing to think about here is some people think they have to wait until they have 100,000, but they really don't. They can get into a house for $17,500 as their down payment. Now, that does not include closing costs, which I will go over in another video. But it's important to understand that you can get into a house for as little as 3.5% down payment. There are also down payment assistance programs, and you can get in with even less. Is my credit good enough? Well, lots of people, maybe you recognize some of these companies, Credit Karma, Privacy Guard, Identity Force, Experian, Identity Works. These are different companies that give you updates on what your credit score is. They're not always 100% accurate. However, they are a good base or guideline. So what does my credit have to be in order to get into a loan program? For FHA loans, our FHA loans are the ones that allow borrowers who have usually the worst credit, the lowest credit scores, and also have had maybe a bankruptcy. They've had, different credit issues or credit events happen. But FHA loans allow as low as 580. So that's kind of the score to think about. A huge thing with credit is the better your credit is, the better your rate will be. So it's really important to understand that while you can have poor credit and still get into a home, it's really important to know that it will affect your credit, the interest rate that you get. So for instance, if you have a credit score of 600, let's say, and we get the rate at a 600 credit score, it might be, I'm just throwing a number out there, 4.5%. But if your credit was at 650, another 70 points higher, the rate might actually be at 4.125, which is going to save you money monthly. So rates are definitely impacted by your credit score, but I can't tell you how many times I've talked to people who have said, I just don't think my credit's high enough in order to qualify, and they do once we pull credit. So the only way you know is when you run it. And yes, running your credit several times can impact your score. Most of the time it does when you have lower credit, but hopefully your loan officer or whoever is advising you is talking to you about that, talking to you about your history so that it won't really impact you. The only way to really plan sometimes is to pull credit, but I really hate to do that up front. So hopefully these initial questions, maybe you've thought about them already, maybe you haven't, but hopefully this helps moving forward in this process. Look out for more first-time homebuyer videos where I give more information. Have a great rest of your day, and always know that you can email or text me by clicking the info below. Thank you.